What is going on, investors? Hopefully you guys are having a great day out there. It's time to keep a bank's earnings moving along here. We take a look at Wells Fargo, ticker symbol a WFC. The company just came out with their Q4 earnings. We'll get into them. We'll take a look at the revenue, the profits, see what's driving the strong results we saw over at Wells Fargo. We'll dive into these numbers, two things that we'll take away. Number one, we'll take a look at Wells Fargo specifically, but we want to take a look when we're looking at bank stocks. It gives us like the clearest picture into the economy. We can't always trust government data. We can't always trust these CPI numbers. Well, we can trust deposits and loans at a bank. And so we'll take a look at those and see if we can't draw some conclusions based on what we're seeing here. And then we'll take a look at this from a technical perspective. This is absolutely gorgeous. I mean, I'm falling in love. It's only 5:30 in the morning out here in California. I tell you what, over the last 5 years, stock's up only 1%. This stock took a major dive. They had a lot of problems. They had those account issues. They had those problems with the government. They're still having issues getting over that. They have a small dividend yield compared to the others, but it is starting to come back. And I tell you what, if you bought the dip on Wells Fargo, you're up huge, okay? Over the last year, this stock's up 65%. No, this isn't a tech stock. This isn't a Cathie Wood stock. This is Wells Fargo, up 65% over the last year. Pat yourself on the back if you took a risk and bought this one. You've been rewarded very nicely. Now, in terms of the Q4, that came in at $20 billion. Whoa, on that revenue side, that's up 12.8% year over year. Now, some of it had to do with the fact that they did sell some businesses in the quarter. They sold their corporate trust services and their Wells Fargo asset management business that did bolster up their EPS. But when we get into these numbers, we'll see that this company actually is doing a nice job cutting costs. So I just did a video on JP Morgan. I'll put a link to that up above. Well, JP Morgan is not cutting costs. In fact, their costs are rising, and that negatively impacted their earnings. We're not seeing that with Wells Fargo. In fact, we're seeing the opposite. So from a high level, we're seeing this total revenue that came in at $20.8 billion. Last year, we're sitting at just $18.5 billion. Hello, that's absolutely fantastic. Now take a look. What I talked about, how their non-interest expense last year is sitting at this $14.8 billion. Now you're down to $13.2 billion. So they're doing a nice job there. Them, like a lot of banks, are getting those credits on those provisions for credit losses. So a lot of these companies put aside a massive amount of money when the pandemic started. They're slowly starting to release that, as I'll show you evidence of. The consumer and businesses are just piling that money into bank accounts. So the rise in revenues, the fact that they sold some assets as well in the quarter, really boosted this net income. Look at this. You went from $3 billion up to this $5.7 billion. Some of that not necessarily reoccurring, but they did earn this $1.38 per share. This company pays just 80 cents per share on that dividend. People are piling into this stock because they know once they get past kind of their regulatory hurdles, and it looks like the worst days are probably behind Wells Fargo, well, they're going to be able to bolster up that in the future. Now, in terms of kind of a just overall balance sheet, take a look, and this is kind of going to be one of the themes of the video. Take a look at average loans went from $899 down to $875. You don't like to see that, okay? From the bank's perspective, from a consumer perspective, maybe you're cleaning up your credit, you're moving out some of that debt. Well, I tell you what, maybe kind of moving away some loans is good. Well, from a bank perspective, it's not good. And take a look at average deposits, went from $1.38 billion up to $1.47. So what is this showing you? That consumers are still putting money into a bank account that earns nothing, and they're not borrowing money. Look, the Federal Reserve has only talked about raising interest rates. Yes, they've moved up a little bit on that home loan side, auto line, credit line side, but look, they're still historically just rock bottom interest rates. Consumers are just not demanding. It's really interesting. We see over here on that average loans down 13% on that consumer side. We see commercial banks down 3% on that average loan size. And then, but take a look at corporates. And so I think this is where you understand where the smart money is. Take a look at corporates and investment banking. Their average loan is up 13%. And then we come down here to deposits. Take a look at this. Consumer banking, their deposits are up 13% year over year. Commercial banks are up 12%, but look who's doing what I think is the smart thing. Look, maybe for you, the consumer, the father, the family man out there, not necessarily something that you need to do, but think about it from a business perspective. When interest rates are super low and you think that they're going to go up, what should you do? You probably should start pulling money, and that's what corporate and investment banks are doing. Take a look at that. Average deposits actually down. That's actually what you want to do in this environment, is actually pull money out of your bank and go borrow it, because not only that, because you have inflation too as well. The value of your dollar today is going to be worth less at year's end if you believe there's lots of inflation. So it makes sense to borrow that, pull that money out now and spend it, because it's going to be worth less at the end of the year. You love what corporates are doing over at Wells Fargo. Now, in terms of that non-interest income, that came in really nicely. Okay, you had $9.2 billion in the most recent quarter. Okay, now that is down, or just fractionally down. Okay, it's basically flat year over year, but it is up 4% a quarter over quarter. Now, on that non-interest income side, that's up. Hello, I love fees. I love charges. That's up 27%. You went from 9.1 billion up to this 11.6. Quarter over quarter, you're up 17%. You went from 9.9 billion up to this 11.5. It was a fantastic quarter. Okay, charge-offs, we talked about how they're actually benefiting from those. That gets you down to this net interest expense. I wanted to show this to you because, again, I posted that video about JP Morgan. Their costs were rising, and we're seeing with Wells Fargo, those are actually going down. They went from 14.8. This is all the salaries, all the employees that went from 14.8 down to 13.2. They're cost cutting. They're doing a nice job over at Wells Fargo. Again, we see evidence of these loans actually decreasing. You went from 899 down to 875, and deposits are increasing. I mean, it's just crazy what people are doing. You went from 1.3 up to 1.47. It's showing you that consumers and businesses are concerned. They're being cautious, okay? They're not feeling confident, and so that should tell us a lot about the economy. Now, last thing I want to look at before we get into this from just a gorgeous technical setup that Wells Fargo is leading up into, I wanted to look at the individual segments, and this gives the consumer side. So this is your average Joe consumer like you and I. So we have home lending here that came in at $1.843 billion. We're seeing that's down solidly 8%, not only year over year, but on a quarter over quarter basis as well. So we're seeing home lending start to slide. We saw it slide quite a bit, even more than this over at JP Morgan, and we're seeing home lending slide over at Wells Fargo. What does that tell you? It's telling you, and it's telling me, I think, that home prices are probably getting too high. Not only that, you have consumers worried maybe about interest rates as well. They are not confident. They are not buying homes. They're not taking out as many loans to buy these homes. What does that tell you? That we could, at least, at the very least, I think, start to see a flattening of home prices. It could, at the worst case scenario, start to see those asset values start to decline. I don't think banks like Wells Fargo would like to see that, but you are seeing a decline there. Now, on the credit card side, you're seeing relatively flat. It's up a little bit. You went from 1.3 billion up to 1.4 billion. So people, instead of taking out a home loan, buy a appreciating asset, they're actually taking on more credit card debt that typically buys depreciation assets or stuff like vacations or things that basically don't perform for you. Now, on the auto side, we are seeing an increase here, and it'll be interesting to see in subsequent quarters. Is this a demand for autos, or is this the fact that auto prices, I think I saw the other day, have gone up like 25, 30% year over year? So it could be that we're seeing a steady demand for automobiles, but the the value of those loans has to go up as the price of that asset goes up. And so we'll see in subsequent quarters. It'll be interesting to see with automobile loans. They are up 17% year over year from 403 up to 470, and they're up 6% quarter over quarter. Is this due to people really demanding their car loan, or the fact that they're just having to pay more? I think those are questions that we have to ask ourselves. I think it's very, very clear on this home lending side, especially because we can back this up with JP Morgan's home lending data as well, that we're seeing a decline in interest of taking out home loans. I think primarily due to the fact that the prices are just absolutely ridiculous when it comes to homes. Now, personal lending down 9%. You went from 142 down to 129. Very small business over at Wells Fargo, but it's showing you that there's a shrinking amount of demand there for home loans or in personal loans as well at Wells Fargo. Now, from a technical setup, it does not get any better than this. This is absolutely gorgeous. You've got a lower upper channel and you've got an upper channel as well going up. This stock is locked in an uptrend. Now it is at the top of this range, and when it's gotten to this top of this channel, it has gotten rejected and come down. That's actually what I personally think you'd like to see with Wells Fargo, because I think you want to buy the dip on this one. Okay, if it stalls out up here, which is where the stock is right now, if it stalls out up here and starts to pull back, okay, depending on the velocity and the speed, remember this downward channel line is going to continue to go up. So depending on how steep and how quickly it pulls back will depend on where you get to buy it. Okay, if it pulls back very quickly, you'll get it down here at $50. If it takes its time, it might be here at $53. Okay, and so it just depends on how quickly this stock, I would expect it to, because look, this is what it's saying from a technical perspective. I'm not guaranteeing this. I'm just telling you what this is telling us from a chart perspective is that it's going to get rejected here. It's going to pull back, and you will want to buy this pullback on Wells Fargo. I think you want to buy it from a technical perspective, but from a fundamental perspective as well. Like I said earlier, I think the worst days are behind Wells Fargo. They're doing a very nice job cost cutting over here, and it could be that the consumer is just stupid, okay? They are saving money when they should be spending it, and they'll do the reverse. When interest rates rise, they'll actually do the reverse of what you probably should be doing, what the corporates are doing. They're taking that money now because they're seeing interest rates potentially hike in the future. They're also seeing inflation, so they're pulling that money out now. I would say this is the smart money, and not to look, I'm putting myself down as well. I'm saying the consumers could be considered maybe the dumb money, and that they'll let inflation rise, they'll let interest rates rise, and then they'll come out there and they'll take their money out of their bank and they'll go and start taking out loans to buy houses, buy cars. We'll see evidence of that in these financials. Right now, though, we are seeing evidence of a consumer that is concerned, that is worried, and they're not taking out more loans to buy things like homes. And that could mean that we see declines in asset prices like homes in the future. Keep a close eye on that here on the channel. That was Wells Fargo. Hopefully you guys enjoyed this video. Be back again soon with more. Good luck with your investments.